50% annual percentage yield is a figure often advertised in decentralized finance. This high return is generated through a practice called yield farming. Yield farming involves staking or lending crypto assets on decentralized protocols. The yield is frequently paid out in the protocol's native governance tokens. These advertised returns are highly volatile and never guaranteed. The core mechanism operates without traditional financial intermediaries. Yield farmers provide capital to specific liquidity pools. This capital enables decentralized exchange and lending activities. The high annual percentage yield compensates for inherent volatility. It also compensates for the complete lack of regulatory protection. Your capital is exposed to significant risks. These risks include smart contract failure and sudden token price collapse. Understanding these risks is mandatory before deployment. This strategy is strictly high risk, high reward. Liquidity pools are smart contracts designed to hold 2 or more crypto tokens. These pools facilitate decentralized trading activities. Automated market makers, or AMMs, use specific algorithms to determine asset prices. The most common algorithm is the constant product formula. This formula maintains a constant product between the quantities of the two tokens. Liquidity providers deposit equal value pairs into the pool. A common example is depositing Ether and USD coin. In return, liquidity providers receive specific LP tokens. These LP tokens represent their proportional share of the entire pool. Holding LP tokens entitles the provider to a portion of the generated trading fees. These fees are paid by traders utilizing the decentralized exchange. Yield farming requires staking the received LP tokens into a separate farming contract. This contract is often simply referred to as a farm. The first source of yield comes from transaction fees. These fees are paid by traders using the liquidity pool for swaps. A secondary, often much higher, is paid in the protocol's native governance token. This token distribution mechanism incentivizes initial liquidity bootstrapping. It also serves to decentralize the protocol's governance structure. The advertised annual percentage yield figures include the value of these newly minted governance tokens. This mechanism relies on continuous issuance of new tokens. This issuance creates inflationary pressure on the reward token's price. Impermanent loss is the difference in value between two scenarios. The first scenario is holding assets in a liquidity pool. The second is simply holding them in a wallet, known as hodling. Impermanent loss occurs when the price ratio of the deposited assets changes. If one asset significantly increases in value relative to the other, the pool automatically rebalances. The automated market maker sells some of the appreciating asset to maintain the constant ratio. This results in fewer units of the appreciating asset upon withdrawal. The loss is only realized when the LP tokens are redeemed for the underlying assets. If the asset prices return to the original deposit ratio, the impermanent loss disappears. High market volatility directly increases the probability and magnitude of this loss. This risk must be factored into all yield calculations. Smart contract risk involves vulnerabilities present in the underlying code. Malicious actors can exploit these vulnerabilities. Exploits can lead to the total loss of all deposited funds within the contract. Professional security audits reduce the risk of code failure. However, audits never completely eliminate the possibility of an exploit. Rug pulls are a specific type of exit scam. Project developers execute a rug pull after attracting substantial investor capital. Developers drain the liquidity pool by exploiting hidden administrative functions. These functions are often backdoors embedded in the contract code. A successful rug pull instantly causes the native token price to drop to zero. Investors must verify the legitimacy and track record of the development team. Advertised annual percentage yield figures often assume constant compounding of the native reward token. They also assume the token's price remains stable. High annual percentage yield is frequently sustained by massive token emissions. These emissions cause significant inflation in the reward token supply. If selling pressure from farmers harvesting rewards exceeds demand, the token price collapses. This depreciation drastically reduces the effective yield for all participants. The realized annual percentage yield is often much lower than the advertised rate. Sustainable yield relies on genuine protocol revenue from transaction fees. It cannot rely solely on inflationary token issuance to maintain high returns. Yield farming income is generally treated as taxable income upon receipt. The income is valued at the fair market value of the token earned. Swapping governance tokens for stablecoins or fiat currency constitutes a separate taxable event. This swap triggers calculations for capital gains or losses. The regulatory environment for decentralized finance remains fragmented globally. Regulations are continuously evolving across different jurisdictions. Investors must maintain detailed records of all transactions. Records must include dates, amounts, and fair market values for compliance. Failure to accurately report decentralized finance income can result in severe financial penalties. Consult a qualified tax professional regarding specific jurisdiction rules. Prioritizing stablecoin pairs minimizes exposure to impermanent loss. Examples include using USD coin and DAI pairs. Utilize established, battle-tested protocols with multiple successful security audits. This significantly reduces smart contract risk exposure. Diversification across multiple chains and protocols is essential. This limits exposure to single-point failures or chain-specific exploits. Monitoring the total value locked, or TVL, helps assess pool stability. Deep liquidity depth indicates a more mature farming pool. Investors must only deploy capital they are entirely prepared to lose. Never farm with funds essential for daily living expenses. The potential for 50% annual percentage yield correlates directly with extreme risk. This strategy is suitable only for sophisticated investors. These investors must possess a high risk tolerance. They must use capital that can withstand a 100% loss. Investors must prioritize understanding the mechanics of impermanent loss. This understanding is mandatory before deploying any capital. Due diligence requires verifying all security audits. Analyze the tokenomics for potential inflationary pressure. Confirm the legitimacy of the development team to avoid rug pulls. High yield is the market's compensation for accepting these elevated financial risks.